This is the Alhambra Investments Weekly Market Pulse, where we talk to Joe Calhoun about things he saw last week that he considers interesting, important, and significant. And Joe, some of the things you saw last week was that consumer sentiment hit a 10-year low, inflation hit a 30-year high, and so the natural next progression would be an economic slowdown. And all of that fits into the Katona effect. Explain that, if you would.
George Katona is the guy who developed the University of Michigan Consumer Sentiment Survey, and he was kind of a original behavioral economics kind of guy. And what he said was that when you get volatility in the price level, or volatility in inflation, however you want to say that people pull back and they don't spend as much. They save more, they spend less. And so that was kind of the genesis of the University of Michigan Consumer Sentiment Survey. They watched this consumer sentiment. So we've seen this now in kind of in action. Got a lot of volatility in inflation, volatility in the upside, and people are the sentiment is falling. And so naturally, what you would expect next is if sentiment is sour, then they'll spend less. Now, I think there's some reasons why that may not be true this time, but we'll talk about that a little bit more. But that is the progression. Sentiment sours, and then people stop spending because of this fear of inflation. You know, the natural. You know, by the way, that's contrary to what kind of we hear from other people about inflation. They say that, well, if inflation's picking up, people are going to hoard things. They're going to buy. They're going to rush to buy things before the price goes up more. But reality is that's not the way people really react, at least in the short term. In the long term, that might be a different thing once they get past, if they decide that the inflation is going to be permanent, I suppose a better way to put it, or long lasting, then they may start to do that other behavior where they start to hoard things. But the initial reaction when prices go up like this is people just pull back and wait. And that's kind of where we are right now.
And so far, we really haven't seen that pullback in spending.
No, not really. People are still spending at a pretty healthy rate. Consumption and retail sales are well above the trend that we were in prior to COVID. So people are still spending at a really rapid rate. So that hasn't happened yet. And like I said, there may be some reasons why that may not happen this time with the Katona effect. There's some problems with the University of Michigan survey.
Well, you know, the JOLTS report came out this week, and is part of the reason you think that we haven't seen a slowdown in spending because there's still a lot of positive outlook in the labor market?
Well, yeah, that's another thing I talked about in the report is the difference between consumer sentiment and consumer confidence. Consumer confidence is a different report that we get from the Conference Board, which also does leading economic indicators, just as an example. So the consumer confidence report is more about the overall general view of the economy, whereas the consumer sentiment survey is about your own personal situation. So we look at the consumer sentiment survey, and a quarter of the people who responded said that they lost purchasing power last year, that their personal situation got worse. 50% expect it to get worse over the next year. They expect to lose purchasing power. But the consumer confidence survey is really more about the labor market and the general economy, which continue to be pretty good. So we see this divergence between consumer sentiment and consumer confidence. The JOLTS report is quite interesting because we're seeing this quits rate at a very high level. And the quits rate at a high level would generally indicate that there's confidence out there in the economy. Again, not necessarily at the personal level. People can be having a bad personal financial situation, but still think the economy as a whole is okay. And look, I think that this quits rate is really about people saying, you know what, I've got a bad situation here personally where inflation is going up faster than the money I'm making, and I'm going to do something about it. They're quitting their jobs and trying to find a better one, or starting a new company or doing something to try to get out of that situation. So I think it's kind of natural. So look, the hires rate on the JOLTS report is the one that's still lagging. There's plenty of job openings. There's plenty of people quitting their jobs, which shows confidence, but there's not a real high hires rate yet, which I think maybe goes to a skills gap or something like that. But whatever it is, the hires is the important part in a sense. So that needs to start picking up, and we'll be monitoring that over the next few months. By the way, the JOLTS report it lags quite a bit. The report we just got was for September. We'll see if the hires rate starts to pick up in October. It's going to be interesting.
What did interest rates tell you last week? Nominal, tips rates, all of that.
Well, it tells me that people are really afraid of inflation because they're buying the heck out of tips. Tip yields hit an all-time low last week. The 10-year hit a minus 1.2. That's just a stunning number. And I listened. Somebody said, "Oh, well, that can't go much lower." And I thought, well, yeah, actually, it can. The 5 years at like minus 1.9. So I mean, it can go lower. Nominal yields went up. So we get these inflation numbers out of the CPI in particular, which was hot and unexpected. And so what did people do? They bought tips and they sold nominal bonds. It's a perfectly logical thing to do. From our viewpoint, though, the drop in real rates is problematic because that's how we kind of track real growth expectations. And so to us, that is a sign that real growth expectations are continuing to fall. Now, there's a lot of things mixed up there between inflation fears and growth. But if you think about it, it kind of makes sense that real growth expectations are falling as people are worried about inflation. They're worried about their purchasing power. So they're trying to do things to protect purchasing power, which means they're not doing things, not making investments that will positively affect growth. So they're kind of related. So I don't know. We'll see. I mean, look, the economy has not picked up a whole bunch here in the fourth quarter. It's certainly, I think, improving from the third quarter. But I don't think that there's no boom in our future here right now, put it that way.
Jump over to the stock side. Did this have any real impact on the stock market?
Yeah, not really. Stock market's kind of nuts on its own. I posted a chart in there this week about margin debt, which is at an all-time high. It's just a stunning number. Look, people are speculating all over the place with borrowed money. This thing about low interest rates, by the way, the theory says that low interest rates like this should spur investment. Yeah, not so much. As I said in the piece, you can lead a horse to water, you can't make him drink. And the same thing is true. Companies don't necessarily want to borrow for these investments, but boy, speculators sure do. So that's where we are right now. People are borrowing to speculate. They're not borrowing to invest in the economy. Again, that's not a positive sign for growth.
All the things that you saw last week, do you think we've seen the worst of this? Do we still have a ways to go?
Oh, I actually think it's probably got a little more to go on the inflation side. Inflation, the CPI and the way it's calculated and so forth, particularly with rents. Rents are rising pretty rapidly, and that doesn't look like it's ready to end yet. So those numbers are just starting to feed through. I will say, though, on a hopeful sign is that a big chunk of the rise in the CPI is about energy, whether it's heating oil, natural gas, or just gas prices. That's like half of the move in the CPI. So, if that were to moderate some, then I think we can pull back on CPI, but we'll see.